Hello traders, Gary Wagner here, just after 11 o'clock in Honolulu, 4 o'clock in New York on Wednesday, 13th day of November 2013, and this is the daily report for gold and silver. Mixed bag in the precious metals markets with gold higher, platinum, silver, palladium lower on the day. To gold first, currently trading up about $7 on the day, $13.73 and change. It's had a low of 67 on the day. This is a 60-minute chart. Our low comes in right here. It has also had a high of 1280. You can see our high right here on the hourly chart. Same hourly chart. This time we're looking at spot silver, currently trading off about 16 cents on the day, 20.36 on the low, 20.97 on the high. Again, looking at a 60-minute chart, we can see our low right in here. This is the day, and our high really towards the beginning of the trading day. There's no doubt we have a moderate rise in the gold market today. It's in reaction of a couple of things, but the bull is back. The problem right now for gold traders is that the bull is back, but it's back in the equities market. Standard & Poor's hitting new highs today, along with the S&P. Let's just quickly take a look to see what kind of, how that chart. We're looking at a standard candlestick chart, Standard & Poor's 500. No doubt, when we look at this chart, this market has just been undefined on a range. Any kind of correction that we have seen has been really a very, very small correction. Market comes up, even on this last low, it's really higher and falls above any kind of a long-terming trend line. And in fact, these lows are consistently moving above this plane that is developed, this tact, I should say, or the angle itself. And this market right now, 1780, is without a doubt at a record and all-time high. So what does that do, and how does that affect the gold market? Well, as far as I'm concerned, the one primary influence, the biggest influence with the raging equities markets is money managers, institutional traders, people putting their money into what they believe to be the best return possible. Money is moving into equities, and it's been in equities, and it's not moving out of equities. I believe that the basic fear is that since we haven't seen any kind of a sizable pullback in the equities markets, if you move out of the equities markets and the market continues to move, it's going to kind of leave you standing. And where else are you going to put your money right now to get that kind of a return? Looking at a daily chart is in Japanese average format, and I will convert it because there is a big difference when we look at the two charts. But even with this up day, we're still, as far as the Japanese average charts show us, we're still definitely in a defined downtrend. The one key right now in terms of where I'd like to see this market begin to trade and effectively close above, it's got to be the 61% retracement level. That's 1276, call it 1275. Of course, we have this low that it has not come and tested, and that comes in at around about 1250. I believe that we looked at that yesterday. This low right in here is at about 1250. And this is what I'm talking about in terms of a really definitive difference between an average chart and a standard candlestick. In a standard candlestick, we're using the true open of the day, the true close of the trading session, high and low, as opposed to referring to it against the midpoint of the prior candle. Now, I draw your attention to the fact that we don't have any real relevant candlestick patterns that I've seen. Typically, at a key reversal point, you'll get some indication whether it's a doji like you got here, where you had these small-bodied candles. You had two of them actually clustered between a down day, meaning it opens, closes lower, and an up day, meaning it opens and closes higher. This is, of course, a variation off a three-river morning star. Now, you can have key pivot points and not really get any kind of a candlestick pattern. Here you actually got what's called a piercing line. It's almost an engulfing because you have this entire day almost engulfing the entire trading range of the prior candle. But as you can see, there's a little red that's actually sticking up. And what that tells us is that it was not what's called a true engulfing. When we take a look at this particular candle, it's kind of gone up to the body of the prior day, but it hasn't gone into it. And that to me isn't an extremely bullish statement. You really want to see it overtake at least the prior day. Also, when we look at the MACD, moving average convergence divergence, it still hasn't reacted. Now realize that anytime you're using any kind of an average as a study, by nature it has to really lag behind any other traditional work such as a trend analysis, Fibonacci retracement, or Elliott wave, because Fib retracement and Elliott wave are truly some of the only what I'd like to call leading indicators as opposed to lagging indicators. Leading indicators in that we might look at a market coming down and we might forecast that it's going to move to 1250 or 1239, and that's based on a Fib study here. We're looking at where it's going to go, not where it's at, and not using it as a lagging indicator, which by the nature of anything that uses an average has to be. So traders, we are looking at a 3-day chart. And on the 3-day chart, I draw our attention to the most recent Fib retracement sequence that I have in. This sequence is simply looking at this last rally, which of course is 1181 to 1435. We then have another Fib that we can put in on this last corrective period. But this is the important one now, because when we look at that, you have 1274, that is your 38% retracement, and realize that that lines up to the kind of the 1276 that we just looked at. The market itself, 1274, market's at 1273, so the market itself is just at a little bit below this particular support line. Underneath that, of course, is 1238, and that corresponds to the 1239 that we saw in the other chart. And again, we talk and we look at these harmonics as having some pretty important factors in there. And I'm still looking at real resistance in the marketplace just at around 1300 to about 1306. Now, once again, this is in Japanese average format. Now, this is a 3-day chart, so we take 3 days and we kind of group them together. Gives me a little bit more defined information than a weekly, and that is why I use it. I'm going to go ahead and remove the study so we can look at straight candlesticks. And when we do that, we're going to get a much clearer idea of the last 3 trading days, kind of grouping them together. That's this candle down here. And when we look at it, you can see we are still below this particular point, meaning we're trading at 1273. 1274 is the point that we want to get to. A move on a closing basis above 1274 is going to signal some kind of support potentially in the market. The fact that when we look at this low at 1250, market comes up, makes this high at 1340, 1345. This is 1336 right in here, as high as 1350. When it comes down, as of right now, the actual low that it made is above this particular low. So that bodes well, but we have not seen any kind of solid support yet come into the market, but we are seeing the potential for some sort of supportive action. If you recall from yesterday's report, one thing that I said is I absolutely would not be surprised, and I almost expect some sort of upside bounce after this most recent move down right in here. Now, even with this expected bounce that I actually believe we will probably see, that to me doesn't designate that we have gotten bullish in the market. Again, when we consider, and I'm going to draw this in very, very roughly, but when we consider this long-standing resistance area, and this resistance area is simply drawn from these tops and we're carrying that angle forward, we talked about the fact that when we rallied from 1181 to 1435 and it hit this particular area, we spoke about the fact that that was very bearish. Market comes down, makes a low at 1250, begins to move up, and again we see that once it hit the upper levels of this particular resistance line, unable to take it out, absolutely very, very bearish. So even if we get the market beginning to move up from this point, I wouldn't really construe any kind of true bullish sentiment unless we really broke through this long-standing resistance line. And this resistance line has been in play all the way through 2013, and really we can place the top back in November of 2012. Now, as far as silver goes, this is, of course, a long-term perspective. We are looking at a weekly chart, Japanese average format. We talked about various support and resistance levels on yesterday's show, but what I want to draw our attention to on today's show is really this MACD. Market trades up to $35 and then begins its spiral down from 35 down to 18. That's that, and then our move up, of course, is from 18 to 25, and then we are in a defined downtrend right now. But look at how the moving average convergence divergence reacted to it. You can see that it correctly crossed and moved up. Market comes down and bottoms. We'll just try to kind of line that up here. And we get this really nice spike in the market in which it moves up. But as it hits the top, you can see this convergence as these two lines get closer and closer together. Look at how wide they are here, but then they start getting closer and closer. And now it appears as though we might even see them cross. And of course, if they cross and begin to move downward, that would signal lower pricing. So we want to be aware of that as we look at these different levels of support, because eventually one is going to get hit. It's going to find some sort of support and begin to move off of that. And so we want to have other indicators that kind of filter any kind of triggers that we have in terms of our trade recommendations. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Thursday for another daily update review. Bye-bye.